How far will the stock market continue to fall? Been thinking, what is it, 11 o'clock a.m. Eastern time? I've been thinking about this all morning. I actually got up at 7:15 this morning. Actually got to sleep in, which is nice. But I've been thinking about this all morning, looking at various articles and whatnot, and I'm going to share with you my thoughts. So we're going to start here with my man market-ticker.org. And he's got an article that says the simple facts on equities and debt. Let's just bring this up here. He says, no, the market is nowhere near a buying point, i.e. buying the bottom. In fact, it's probably overpriced at 50% of today's prices, even with the dump that we've had so far. And so just remember, so far, the S&P 500, the highest it's been in the last year is 48.18. Yeah, 48.18, and now it's at 36.36. So 48.18 minus 36.36 divided by 48.18. The S&P is down 24.5%. All right, that's a full-fledged bear market. Relatively deep in a bear market. We've had markets way worse than that, but here we are. We're down you've lost a quarter of your money. So if you had $100,000 and you haven't added to it and you haven't taken any money out, it's worth $75,000. All right, so here is saying it's probably overpriced at 50% of today's prices. So he is saying this guy that could go down to $1,800 and still be overpriced. And here's why. And he gives us this chart here. And he says non-financial corporate business debt securities and loans. Right, and so you can see it's a significant rise, right, from right here to here. Mm-hmm. All right, corporations basically never pay off debt. Since 1980, the cost of money has always been cheaper, so every time a bond comes due and has to be rolled over, the amount of money you must pay in interest is now less. I get you, because you're refinancing at a lower rate. This in turn means the amount the corporations pay in interest goes down, and that means earnings go up. And I completely agree with this so far. But this cycle presumes the rates will never rise. Why? Because if it does, and has for the last 6 months, and every time your bond comes due, now you have to pay more in interest on that new one that replaces the old one. So you got to refinance it to a higher rate, which means you have to pay more interest on your money. Couple things on that though. When you're refinancing, if you're refinancing just on principal, like for instance, that's not very bright there. All right, whatever. Let's say you took a $100,000 mortgage at 3%. All right, so now you got a $100,000 mortgage at 3%. That's $3,000 a year in interest. That's just a fact. Now let's say your mortgage is $50,000, and we're going to say the interest rates went up to 5%. Or 6%, a double of the interest rate. So that's going to be $50,000 is your principal that you're refinancing, and your interest rate is now 6% as opposed to 3%. Well, you can see it's the exact same interest times 6%. You're paying $3,000 in interest. So if corporations aren't paying down any principal, yes, this would be correct. But if corporations are paying down principal, that's a completely different thing. I hope that makes sense. So just because interest rates go up doesn't mean you're paying more in interest. If you're only paying interest only, sure. I don't know if we have any evidence that that's what's happening. I don't know. But anyway, let's keep going. E is the earnings is simply what's left of what you take in after you pay your expenses. And if you have debt outstanding, interest is one of your expenses. Completely agree with that. People say the Fed can't raise rates. Well, they are. And worse, the 10-year is now at 3.7. It's crazy. It's likely headed to 5, which means a AAA corporate bond should carry a coupon somewhere between 5 to 6%. I completely agree. When the best credits out there roll over the next time, which they all will within the next couple of the 10 years, they will pay 6% when they were before paying 2 to 3. I completely agree. I just showed you why in of itself, that's not all that bothersome as long as they've been paying down principal. So the question is how much they pay. I'm going to get into this here in just a second. The only other option is to redeem the bond entirely, which means forking up the face value in cash, which is inherently deflationary, which I've talked about all the time. Debt is deflationary, man. It's just no two ways around that. Take a firm that's well regarded and well managed, Berkshire Hathaway. They have 119 billion in debt outstanding and are certainly a AAA credit. Let's assume the 119 billion currently carries a 2% coupon. So they're paying 2.38 billion in interest. The firm's net income is 11.7 billion. So what happens is if the cost of carrying the debt doubles, that's a 20% whack off earnings. I take a little bit of issue with there because don't forget you can write off interest. So that he's saying the firm's net income is 11 billion. That's net of EBITDA, all right, and interest. EBITDA is interest is part of EBITDA. I forgot the E on EBITDA. I can't remember. Anyway, I can't remember. But anyways, interest is part of it. It is a tax deductible expense. So you're not saying I'm paying an extra $2 billion in interest. That's a 20% whack on my net earnings. It's not quite that. But I get what he's saying. That'd be what I'm saying. So how does a current 58 PE sound to you if we have higher interest rates? And 100%, man. If 58 is high, that means the earnings crash by half. I completely agree. And this ignores input costs, which of course you can't. And of course, input costs are because of the insane energy policies that we have. Another example is FedEx, which reported last night. Revenues largely met expectations, but earnings per share missed by a third. Where did that come from? Input costs, higher energy costs, man. All right, so I don't disagree with that. All right, so we go back to 2021, and they got $112 billion of debt. Whereas in 2014, they only had 79. So they've actually been increasing their debt significantly, has Berkshire, which would mean they're going to pay more in interest without question. I'm not going to go into others. Let's just look at I'm just curious. And here's Apple. They've doubled their debt in the last 7 years. So that is problematic as interest rates rise for sure. Now, on the other hand, they have current assets of 134 billion, which means they're going to have higher interest accumulated on their cash holdings in which to pay that debt. So let's just say, I don't want to say it's washed, but let's just say that as interest rates go up, that costs more to roll over their debt because they're increasing their debt, more so than it does for the income that they're getting off their cash holdings. And I completely agree. But I'm going to show you something here. All right, so this is the chart, again, from the St. Louis Fed that guy showed us. I forgot his name. I think it's Carl who wrote that. That looks pretty ominous, doesn't it? Well, I'm going to go like I always do. We're just going to log it. And I'm just going to, it's a whole different, let's see, we're going to log this guy. And we're just going to show you that the increase in debt relative to the year before, percentage-wise, isn't that, I mean, look at the difference here. All right, so, I mean, it's a gradual increase, man. There's just no two ways around that. It's not the same as if we go here without logging it. That looks like a significant, look at that. Well, my goodness, they had no debt, now they got lots. No, it's just not true. If you log it, it's a gradual increase in corporate debt. And so I've spreadsheeted this here, and we're going to show you here. All right. So increase in corporate debt year over year, and I just took the liberty of using the Fed, and I downloaded it to my Google Sheets here. And you can see, it's like just, here's 2.5% increase in corporate debt. Right there, 1970, the significant increase. But I mean, look at that, man. I mean, just a 2.5% increase in corporate debt, sometimes a little bit lower, sometimes it's negative. A big one here, January 1st, 2020. That's odd. Why was there the sudden increase in corporate debt in January 1st of 2020? Wow, right before we knew about Corona. Interesting. Did some people know? I don't know. Then you had a pretty significant drop off come July, and then we have another run up. All right, so here's the increase in corporate debt, and we can look. I'm going to scroll down here, and we're going to show you the standard deviation on this is only 1.15%. I mean, that means within 3 standard deviations, 98% of the time, well, we can go to, hold on, let me just average it out here. The average increase or change in corporate debt is an increase of 1.94%. Now, this isn't quite year over year because it's month to month, but just be it as it may, it's not nearly the same as what this looks like right here, if that makes it. Actually, what this looks like right here. It's just a gradual increase in corporate debt. There's just no two ways around that. Now, if we go over here, and the average standard deviation is 1.1. So in any given month, the increase in corporate debt would go from basically 3% to 1% on any given month's time with 98% probability going back to 1951. Now the average, that's not the average. The average, just one second, we're going to go to average here. Hold on just a second. The average S&P return since 1951 has been 12.65% with a standard deviation of 17, right? So that means on any given year, we times 17, because I'm making it simple, 17 by 3. That means on any given year, the S&P 500 could be down 39% with a 98% probability, which it was in 2008. It was down 37%. Or it could be up, I don't even know what that is, 12 plus 51, 70%, or something like that. I think it was 54%. There was one year where it was up 54%, like in 1950. Yeah, right there, 1954. And then 1959. So again, the significant change in ranges between the average debt up and down versus the average S&P 500 return. So this, I don't want to say they're not correlated, but man, you can make a whole lot of correlations a lot sharper, tighter than this right here. So, but we are going to put them together in a thing here. I'm going to show you if I can find my chart right there. We're going to see the correlation. So the right axis is the S&P 500 return. The left axis is the change in corporate debt. And I mean, again, 2%. I mean, as a debt, you can make an argument. And I will show you the argument that can be made. As debt goes up and returns go up, as debt goes down, returns go down. Let's see, that's in 1976. Or as debt goes up, returns go down. As debt goes down, returns go up. You can make an argument for that. Here's 1976. Debt was growing slower than normal in 1976. The market started returning decent returns. I don't know. Actually, that's not really true. 1977 was down. Yeah, that's going to be a tough one to make there. 70 in 1970. The debt was way high. Yeah, I don't think there's a correlation to be considered here. I don't, man. I mean, I guess you could make an argument that the more debt, the more return, I suppose. I don't think there's a huge correlation there. So here we got, this is 1991 October. In 1991, the returns of the S&P 500 were 31%. So there you can make a case. Look, man, but that's in October, though. I mean, so October, the market's already been, and that's after the war. I don't think there's much of a core. And this whole thing, the Fed is, increasing is the reason the markets grow is because of Fed. I don't buy that for 2 seconds flat. All right, so here's 1995. The markets are up 38%. The corporate debt was going down from 1986 all the way down to 1991. And then the markets really didn't start taking off until 1994. And then corporate debt was in the increase again. I just don't know if there's a core. I mean, you can make this case. It looks pretty correlated, but what came first, the chicken and the egg? It's kind of like when I say, what comes first, CO2 increase or temperatures? Well, it's actually temperatures that go first and then CO2 goes next. And we know that that's not really debatable. There will be some people that notes that say, yes, it is. No, it's not. Silly. The same thing. Could you say the same thing here? I mean, here's returns. Here's a corporate. I don't know. I don't think there's much of a correlation. So anyway, the point being is just because the interest rates are going up, and the debt levels are going up, does that mean the markets are going to go up, or I don't know what to make of that. I just find it interesting that just because we looked at a couple stocks that had a high increasing debt, they have to pay more in interest payments that could hurt earnings. But I've kind of been saying that for a long time. That's why my growth rate in the S&P 500 has always been about 6 to 6.5%, 4%, 4.5%, 4 to 5% year over year earnings growth, plus 2 to 2.5% dividend yield. That's it, 6.5%. So I don't know. I just I think we have, and I did a video the other day of like all these different metrics on how to predict the markets. Here's another one. The corporate debt equals X. I just don't know that to be true, man. I don't know. Anyway, so what do? Well, hopefully you got 4 years cash and just leave the rest alone. There's not much else to do, man. Could the markets go down more? Sure, we're already down 25%, for heaven's sake. I mean, it's not like we're freaking sitting on a high. We're not. I just, it's like not a very crisp look at my beautiful face when I just shaved. Anyway, love to hear your thoughts, man. We'll see ya.